The benefits of ESOPs, I don't use this term lightly, the most flexible and tax-efficient succession plan. I can't think of a more efficient, tax-efficient succession plan than zero tax if you structure it with that intention. So yeah, it's very flexible, very tax-efficient. You have the ability to create a market for your own privately held, closely held company. The ability to protect the legacy, the identity of the business, which is very important, especially in family-owned businesses and companies that have strong values and things that they want to make sure continue on and are perpetuated. The issue of control. This can be a private transaction. You do hire consultants to help out, but it's not a public auction type of procedure. So you control the information flow. And before, during, and after an ESOP transaction, the board of directors remains in control of that company. So you have the ability to perpetuate the strategies and again, the values and culture of the company. Great possibility for very, very generous benefits to employees post-sale. We'll get some statistics on that later. Fabulous recruiting, retention, and motivation tool for employees. It's a differentiator. It's something that makes a company very different than its competitors in a competitive job market. And if you do a great job with your ESOP, then you're going to see that translate to the bottom line as well in terms of better earnings, better performance, resiliency, less turnover, and we'll share some statistics on that as well. The thing that typically gets the door opened to an ESOP discussion, though, is tax benefits. Okay, it's not the thing that usually ends up making a seller's mind up, but it's what usually gets you the first meeting. Okay, so what are the benefits of an ESOP? For the seller, for the business owner, it's this Internal Revenue Code Section 1042 gain deferral, the ability to roll your capital gain into a replacement portfolio, which we'll talk more about in a moment. And also the ability to create a stock sale where perhaps the only other option you'd have in a third-party transaction is an asset sale with disastrous tax consequences, potentially. So you have a more favorable transaction with the seller. For the company that is acquiring the stock through an ESOP, you have the ability to effect a pre-tax leveraged redemption. For the bankers in the world, they hate financing stock redemptions because it's non-productive use of capital, and it's all after-tax dollars go to repay that debt. So this is a completely different animal. And then ultimately, an S corporation ESOP has the ability to become partially or completely tax exempt. So a tax exempt for-profit enterprise is pretty interesting to a lot of folks. So to kind of help drive this point home of the tax benefits, we wanted to show just a side-by-side comparison of 3 different types of transactions. One would be selling assets to a third party. The other would be selling stock to a third party. And then the third would be an ESOP sale with that 1042 gain deferral election being made by the seller. And there's some assumptions that we've put in here that seem to be pretty typical. In fact, I picked this off of a transaction that's closing this month in Hawaii. It's a C corporation, about a $40 million valuation for the company. The company has about $20 million of assets on the books and $8 million of liabilities. And the shareholder has basis of $1.2 million, which is actually high for most C corporations. Most C corporations, the basis is whatever you initially capitalize the company with. Sometimes it's $100. It's very, very little. So here is the tax impact on the seller, on the current business owner. So the first column is a sale to a third party. If the company is worth $40 million, including the $8 million of liabilities that it has, in our example, then if you're going to sell assets and you're not going to assume the liabilities, you're going to have to pay $48 million for those assets. So let's say that the owner finds a third party willing to buy the assets of this company for $48 million. Then they use $8 million to pay off the corporate liabilities. There's an internal gain within the corporation on the sale of its assets, which had a book value of $20 million, yet they received $48 million for them, $28 million gain. Inside the corporation, taxed at 43.84% is about $12,300,000. So that's a corporate level tax in a C corporation. So at that point, all of the corporate liabilities are paid off, the taxes are paid within the corporation, and you have left $27.7 million available to pay to the owner as liquidating dividend. At that point, the owner receives a liquidating dividend of $27.7 million. At current California capital gains rates, it's 20% federal, 3.8% Medicare surtax, the Obamacare tax, plus California's 13.3%, 37.1% of that 27.7, that's $9.8 million that the seller pays at the individual level. And he's left with $16.7 million. Out of a $40 million company, he's left with 16.7. So tax consequences are pretty horrendous. And this is also part of the reason why ESOPs are popular. Again, not too long ago, that individual capital gains rate was a lot less. It was 15% federal, 9.3% California, 24.3% total compared to 37.1 now. So that's almost a 50% increase in the tax burden to the selling shareholder. So the second column is a lot simpler example. Let's say this owner was fortunate enough to find someone who's willing to buy his stock, which would be a big deal for this company, being a C corporation. So that individual pays $40 million for his stock. He still has to pay individual capital gains on his gain of $40 million minus his 1.2 of basis. Okay, $30.8 million capital gain, $14.4 million of taxes, and the seller nets 25.6. A lot better than the asset sale, but still a lot of taxes being paid. The ESOP comparison is so dramatic that we really don't need to say much about it. You are able to have a stock sale, and there won't be any gain, tax paid on the gain, if the seller makes that 1042 election that we'll talk more about. So very dramatic improvement for the selling shareholder. But let's talk about what happens to the buyer in this case. The buyer has to pay for this company with after-tax dollars, right? So in the first example of that asset sale, if that asset buyer is going to pay $48 million for the assets of this company, he is going to actually have to earn $85.5 million so he can pay taxes of $37.5 and have $48 million left over to pay you. So huge tax burden on the acquirer that is often overlooked. Similar situation in a stock sale. In order to pay you $40 million for your stock, I've got to earn 71 so that I can pay 31 in taxes and have $40 million left over to pay you. Because the sale to the ESOP is all pre-tax dollars going towards this acquisition, you earn $40 million to pay off $40 million of debt. So if you stack these advantages up side by side, you look at the tax paid by the buyer, either 37.5 or 31.2, the tax paid by the seller, and the corporation internally in the asset sale, 22.1 and 14.4, the total income tax paid on this business sale is either $59.6 million for an asset sale or $45.6 million for a stock sale. And what was the value of the company? $40 million. So the government gets far more in taxes than the value of the business. It's an effective, if you look at the total tax hit as a percentage of the fair market value, 149% for an asset sale or 114% for a stock sale. So that's why I make the claim fairly boldly that this is a pretty tax efficient alternative, the ESOP exit.